This podcast is brought to you through our charitable partnership with Children's Home Society of North Carolina. Right now, there are more than 12,000 children living in the foster care system and not nearly enough safe, loving homes for them. Find out how you can make a difference today at chsnc.org.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement. With over 20 years of experience, Semmax Financial Group has been dedicated to serving investors, and through this podcast, we aim to empower you with the knowledge to maximize your savings and achieve lasting financial freedom the Semmax Way. Whether you're a professional finance enthusiast, a high net worth individual, or part of a sophisticated investment group, this podcast is tailor-made for you. And now, here is your host, Matt Landon, financial advisor for Semmax Financial Group and licensed CFP.
Hello, everybody, and welcome. I hope that you are as excited about this as I am. Today, we're going to be talking about something that I think can be kind of confusing. The government makes it that way on purpose. We're going to be talking about RMDs. What are they? How do they work? What do you want to do with it? What is a QCD? How do we tie all these things together? What are these abbreviations? Let me start with the top. An RMD or an MRD, depending on your custodian, it all means the same thing. It stands for a required minimum distribution. You see these most commonly inside of retirement accounts. So a 401k, a 403b, an IRA. You see this a lot with IRA accounts. The idea behind this is they wait until you're of age. Now, that age has changed recently with the Secure Act and then again with the Secure Act 2.0. So depending on when you were born, you will have to take an RMD somewhere between the age of 73 and 75. So let's just go with that 73 figure for ease and convenience right now. So the year in which you turn 73, you have to start taking an RMD. That RMD is based on a factor. So what happens is the federal government looks at you and says, you've got this big bucket of money you have never paid taxes on. They're staring at this IRA account and they go, we want to get our hands on a piece of that. So what they do is they look at you and go, you are required to take a certain amount of money out of this account. And if you don't, we're going to penalize you. We're going to charge you a 25% penalty on what you should have taken out. So we're going to take it, right? There's really no question mark around that. We got to do it. But what happens is they look at the December 31st value of that account and they say, okay, based on that factor, you have to take this percentage out. Now, the first year, that percentage is going to be around 3.6%. Each year, it keeps climbing. Okay. But that first year, it's about 3.6%, which means if you have $100,000 in your account on December 31st, the previous year, at any point in the year, the following year, you have to take out $3,600 and pay taxes on it. Now, what's kind of interesting about this is each IRA account, each retirement account has its own RMD. So if you have two IRA accounts, each one having $100,000 in it, you have to take out that $7,200. But what's cool about it is if you've got two IRA accounts, let's say part of it's in an annuity, part of it's in the stock market, okay? You don't have to take it equally from each of them. You can cover that full RMD out of one IRA account. So if you have an annuity that's giving you $8,000 a year in income, and one account says you have to take out $3,600, and the other account says you have to take out $3,600, guess what? That income you're pulling is covering that full RMD. That's pretty cool. The issue is that doesn't work if you have retirement accounts. So if you have a 401k, it has its own RMD. And so what happens is if that annuity is kicking off plenty of income, it doesn't matter. It's not touching that 401k. So with IRAs, you can kind of lump them all up in one column, total them up, and make sure you're taking the amount. With retirement accounts at like a former work or an employer, you have to look at each one in a separate silo and make sure they're taken care of. And that's one of the reasons why I don't like leaving too much in funds inside of an old work plan. You want to go ahead and roll that out because what happens is they end up becoming orphan accounts. You don't think about it. and then down the road it pops up and you go, oh no, I missed something. Now I've got a tax headache on my hands. So I'm not a big advocate for leaving a ton of small accounts kind of drifting out there. You really want to consolidate and streamline and make sure things make sense when it's all said and done. I'd like to pause a minute and just express our gratitude to our podcast sponsors, Noble's Food and Pursuits. This renowned restaurant group has been serving the community for an impressive 40 years, starting with Jim Noble's original restaurant, J. Basil Noble in High Point. Over the years, their passion for hospitality has flourished, leading them to expand into a diverse collection of 9 restaurants, a retail bakery, and a catering company. Today, we want to shine a spotlight on one of their beloved establishments, Rooster's, a Noble Grill, which has been proudly open for 31 years right here in Winston-Salem. Now, Rooster's is known for its commitment to offering a seasonally inspired, regionally cultivated menu featuring mouth-watering wood-fired meats, poultry, and vegetables. If you're looking for a delightful dining experience, they also host monthly wine dinners and provide live music on their inviting patio every Tuesday night. Now, make sure to pay them a visit at 380 Knollwood Street, and to secure your spot, head over to theroosterskitchen.com and make a reservation. Again, that's roosterskitchen.com. Trust us, you won't want to miss the delectable dishes and warm ambiance that Roosters has to offer. Now, let's continue exploring the world of finance and uncovering some strategies to help you achieve your financial goals. So, that first year, you got to take an RMD. Well, next year, the IRS comes knocking and they say, hey, remember when you took money out of that account? Remember when you took that income out? That was fun. You deserve a raise. So they make you take a little bit more. That percentage goes up because the factor is going down. So every time they raise that percentage, you have to take a little bit more out of your account. And next year, you have to take a little bit more. And the after that, you got to take a little bit more. Now, I'm going to put on my tin hat for just 1 second here. Bear with me as I jump on a little bit of conspiracy theory. But I want you to think about this. If you have a pile of logs and your dad looks at you and goes, you know what? You got to split 10 logs before you come inside. 10 logs. And you're going to have to do that until that pile is gone. Okay? Until that pile is entirely gone, you got to split 10 logs every night before you come inside. Well, human nature, at least for me, my brain goes, all right, you're making me do it. I'm only doing the 10. I'm not doing any more because you're forcing me into it. But then the next day you come out to split your next 10 logs and you realize someone added 6 more logs to the pile. Yet the next day you come out, it's happened again. It's the same kind of idea with RMDs. I feel like our brain, we go, if you're telling me I have to take this much out of an account, I'm going to take that much and no more. But then the account balance grows over the course of the year. Next year, you got to do it again. Next year, you got to do it again. Before you know it, 20 years have gone by. You're 92 years old. You're still paying income taxes. You've been retired for how many decades? What the IRS has done is they've basically reverse psychologied us into paying income taxes indefinitely. I'm not a big fan of that. So I look at it and I go, okay, let's cover that RMD. Let's do what we have to do. But could we go ahead and do any Roth conversions? Should we be taking any more out of that IRA account when we're in a lower tax bracket to avoid being pushed into a higher tax bracket when taxes go up in the future, which they may? Now, the Congress and the White House is not phoning me up telling me exactly what they're going to do with taxes 10 years from now. I don't think anybody knows. But I think we can all agree they're probably not going down. So when I think about that, I look at it and say, what's the best way to strategically pull money out of that IRA account? We're going to do a whole separate episode where we talk about Roth conversions and Roth accounts and how they work. But the key thing I would say here is by the time you get in that RMD, you've got some restrictions. You can still do a Roth conversion, but you better have covered your RMD first. So you got to make sure those first dollars coming out of the right way. Now, here's the other thing with RMDs. It's not just for the retired folks. If you leave an IRA account or retirement account to your kids, they have what's called an inherited IRA. So you might be in a situation where you've received an account from a parent who unfortunately has passed away. But what ends up happening is now, thanks to the Secure Act 2.0, appreciate it, Congress, you only have 10 years to fully deplete that account. You have to take money out of it every year. And what happens is you've got 10 years to unfund that account. That RMD clock starts ticking. And instead of the rest of your life, it's a 10-year countdown. So you want to be careful about that. And so when we talk about RMDs, for most of us, it's just a part of retirement. It's a facet of retirement. But I do think it's important if you can do some strategic planning on the front end to reduce that impact or to negate it entirely, both for yourself as well as your loved ones. I think there's an incredible amount of value there. The last thing I would say on Roth or on RMDs is this. The government has the ability to change the rules on us. They can do it at any point in time. They've already done that with changing the RMD age. That's in some cases, people think it's a positive. In other cases, some people think it's a negative. They've changed how RMDs work for inherited accounts. They could just as easily change the rules again. Right now, we're operating under the assumption that you've got 10 years if you're a beneficiary, but they could change it to where you only have 5. They could change it to where you only have 2. We don't have any control over what Washington does. We just have to abide by the rules that they lay down at the time that they apply to us, right? So the big thing with Roth conversions for me, the big thing with RMDs for me, the whole kit and caboodle, I look at it and the key takeaway really should be, let's make sure that we're not having too much of an impact. I'm a big fan of having less government interference in what we're doing and have a lot more independent autonomy over our own decisions. RMDs just feel like a bit of a forceful push from the government kind of telling you what you have to do with your money. The nice thing is they're not telling you have to go spend it. They're not telling you have to turn around and reinvest it. What they are just saying is you got to pay a certain amount in income taxes. So if you haven't thought about it, you need to be doing some critical thinking now and saying, before I get to that RMD age, what can I do to mitigate the impact or reduce the impact of this? If you're in RMD age, you still want to look at it and kind of consider, how do I handle this? How do I navigate it? And is there a way that I can strategically maximize which accounts I'm pulling from and how I'm doing it? But the big thing there is it all comes down to planning. And one of the key components with planning is understanding how it works. So if you've got questions, if you've got thoughts about it, we're going to keep diving into this. I hope you're enjoying this as much as I am. But when it comes to RMDs, there's a lot of questions. There's also a lot of answers. We have really scratched the surface here. There's a little bit more that goes into it. But the key takeaways here is that if you have an IRA account, if you have retirement accounts, you're going to have to take an RMD at some point. Oh, one last thing. There is a way you can get around taking an RMD when you're 73 years old. If your funds are still in a work plan and you're still employed by that employer, if you're still working, you can still contribute. You don't have to take an RMD. But if you have retired, that RMD kicks in right away. So you've got a get out of RMD free card, if you will, but it's not really free. You're paying for it with your time because you're still having to work. So that's one thing that you can do to avoid it, but I don't think we want to work forever. So there might be some other ways you can get out of it instead. If you're interested in exploring those, you can reach out to us. We'd love to talk to you about it. But on behalf of the whole Semmax team, my name is Matt Landon. I'm glad to be joining you. I look forward to next time. I hope you enjoyed us diving into this little slice of pie. We got a whole big one to go through, and so let's keep going in. It's been fun. Thanks for listening.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor, respectively, for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.